What's up, YouTube? It's Joe Catapaglia sitting on the couch, making some money, investing in fractional real estate online, as usual. Today, we've got a new VIP launch for a Mogul property, the McIlroy, I guess? McIlroy? I'm not sure. They mentioned in this email something about Team Europe, so I'm assuming this is a sports person. I don't know. But I never get the reference for hardly any of these, so you're just gonna have to bear with me. But anyway, it's a Padsplit. It's in Houston. So far, the Houston Padsplits have sold out incredibly quickly. Based on what I've looked up so far, I'd be surprised if that's the case with this one. There's some things, quite a few things I want to talk about, but I'm going to go through all the normal due diligence on it. Before I do that, you might have, if you own the WAGs, this property here, which at least this one I did know who these were. I had watched some of, I didn't get it right away, but I had watched some of Billionaire or whatever this is. But anyway, if you own some of this one, you got an email today mentioning that, this property was listed for foreclosure. And what happened here? Well, apparently when we bought it, there was a lien from the previous owner, a mortgage that the previous owner had taken out that wasn't disclosed. It wasn't caught in the title search. So it wasn't paid off at that closing. The email came from Alex, the CEO of Mogul, and saying, they think that this is an issue that's going to be, well within the confines of a title insurance claim that, it's, and it to me, it sounds like it is as well. I mean, it is, obviously I'm no longer an attorney and I was never your attorney, unless you're a past client that happens to be watching this, but even still not an attorney anymore. But at least, based on my general knowledge of, title insurance, this sounds like it fits very squarely into what should be covered, right? It's a lien that, this is why we get title policies, so that if something like this happens, there was a, pre-existing lien that we weren't aware of, and wasn't accepted from the policy, then, we're protected from that by the insurance. And so, they mentioned it's probably going to take, somewhere around 60 days for that settlement. They've already retained their, attorneys to look into it, do the work and whatnot. And their opinion, the attorney's opinion, according to Alex, was that this seems, well within, what should be covered. So it's interesting because this is, a second, we had a rough month, last month, or the dividends that we got this month from last month was the first little bit of a disappointment from Mogul. Although I do believe what they had to say about there being, it being a seasonal issue. And so we'll have to see if that continues or not. But then, this is something that is a serious issue, and seeing how they handle it is going to be really telling about the platform in general, I think, right? And so far, getting some information directly from the CEO, letting us know what happened, what they're planning to do, and what they expect the outcome to be, right? And he said, we can't promise it, but we believe your capital is completely safe. And, letting us know he's going to keep us in the loop. Hopefully that's accurate. Hopefully we get kept in the loop all, through the whole process. And when everything's said and done, we get paid out, by the title insurance and made whole. Now, will we get paid, just the initial investment? What's that going to look like? I don't know. Right. And so, it's one of the reasons I've talked about this lots of times. I want to go slow as far as adopting new platforms, putting money in. Mogul has been my favorite platform, for a while, and it still is. So far, nothing about what has happened here. If it's an error on the title company's part, there's nothing that, I would have expected them to do to find out about that ahead of time. And especially if it's covered and it goes through smoothly, I'll actually take this as a good sign, right? Before I forget, please like and subscribe. In the description of this video, I've got links to all the places where I currently invest in fractional real estate online, Mogul being one of them. There's also a link to the Mogul.Club that I'm a member of. So if you haven't joined a Mogul Club, and you're investing in Mogul, I'd recommend joining a club. I get club rewards, and as far as I can tell, there's no downside. Now, obviously, I want you to do your own due diligence on all the platforms and any of the properties. Don't just buy into these because I am, and don't just not buy them because I decided not to buy, right? But so that's what I think is going on with the WAGs. That's all I know. Nothing beyond what you did, but Ike, always helpful in the Discord, actually found this, and I've never even heard of this site. But found the foreclosure listing. It looked like the auction date was on the 2nd. So, and based on the email, I'm not completely sure if the property was actually auctioned and taken over or not. That was unclear to me, and I didn't ask a question to clarify. So, anyway, let's jump back into the property that we're talking about, the McIlroy or I don't know. Well, I'm going to try to not say that name too often because I don't know the right way to say it. So this is actually a little bit worse than their average deal, right? You see their year one yield pre-growth 8.1%, average yield over hold period 13%, annual levered IRR 12. We're used to seeing these 14s and 15s from them. So this is a little bit of a step back, and I don't know, I know it's hard to find deals. I don't know if this is just really reflective of, okay, the market's getting tougher. They've already picked off a lot of the low hanging fruit. I'm just not sure. I'm not sure why they're bringing one to us that is, below what their average is. I don't think this is a bad deal, right? If I'm getting high single digit cash on cash returns, I don't necessarily, some of the short-term rentals I've accepted that on. Most of the pad splits have been, 10% plus or somewhere around there, high 9. So this isn't like so far off, but it is, it's noticeably worse than a lot of the ones that we've looked at. Let's jump into, though, some of the due diligence, and then I'm going to get back to some aspects of the property itself. I looked at the zip code, the Zillow home price trend in the zip code. It's actually gone down 2.2% over the last year. That's not surprising. I mean, we've kind of seen this shape in a lot of markets. They're expecting it to go down a little bit more in the near future. Houston is a market that I really believe in long term. They have, I didn't pull up all the normal stats that I do for markets because we've looked at Houston a bunch of times on this channel. But the reason I like it has very strong, job growth, population growth, all the indicators of why I'd want to being a market. Houston, and I think that's why the other pad splits in Houston have sold out well, right? Like it's a market people are looking for access to, and so obviously I like that. Let's see. Oh yeah, I didn't finish doing this. I was starting to map all of the, why didn't I grab the last one? All the comps that they use. Let me do this last one while we're here. See if I can break my computer because it doesn't like me to do anything while I'm using the screen recorder. Let's see. Let's see where this last one is. Yeah, okay, those are all reasonably close. But we're gonna come back to that. We're going to get the easy stuff out of the way so I can close those tabs. FEMA flood map. This is another one of these that is in the shaded X zone. We covered this with a couple of properties now, some on Lofty, some on here. But it is, normally I would like to be in an unshaded X zone. Like that's my preference. That's I think basically the lowest risk zone that you'll see. This shaded X, I have at this point invested in a few deals that exist in that portion. It indicates, okay, 0.2% chance of flood hazard, areas of, what is that? Of 0.1 or 1% annual chance flood with depth less than 1 foot. So I don't love it. It's not, but I think this is not the end of the world. If this was a deal that I liked everything else about, I think I would be okay with this. I think that the Hugo might have been in that, the shaded X, and maybe was one of the first ones that I bought and had that discussion in. In general, I know the guys at Mogul seem very savvy about how they handle insurance, and so if they're in a zone where it's required, it's something that I believe they'd be covered. And even though I don't like to buy properties in flood zones that I want to deal with the whole property, well, that's because I've handled a few insurance claims on properties over the years. I hate doing it. In a fractional real estate setting, somebody else is doing that for me. If I believe in that team and I think that they're going to do a good job, it makes me take a little bit, and you've seen me do this with some of the Mogul properties, with some of Earl's properties. I've been a little bit more willing to take on a risk like this when I'm not the one who has to deal with it. And I'm also making a small investment, right? So if I liked everything else about the property, I'd probably be okay with this. But as I mentioned, it also has worse numbers than most that we've seen. And then I'm also going to, sorry about that. That was not my screen recorder's fault, as I usually blame it. I opened a tab that I shouldn't have, showed some info that I didn't really want to, and so I had to cut that out and stop the video, cut that out, and start up here. But so anyway, like I said, there's going to be a couple other things I don't particularly like about this property. So this is just one more strike against it. Let me close that. Let's see. Ad removed. What's happening here? Man, we're having just all sorts of problems. Okay, great. I got the spot crime map up for Houston. Now, keep in mind, this is only a couple of days of crimes. But for a spot crime map in Houston, this looks amazing, right? Compared to a lot of them that we've seen. You have to zoom out, and you can see plenty of other issues around there. But for the neighborhood itself, at least in the last couple of days, nothing reported. I know that seems like to only have a few days of data sometimes it's tough. I like it when you have a couple weeks or a couple months. That's not what we have here. I have started looking at some other crime heat maps and whatnot. None that I just love. If anybody has a good map that they use to look up crimes consistently, the big problem that I have is that you can find them for a lot of different markets, but they're not necessarily very consistent from one market to the next in the way that they display stuff. It's kind of why I've reverted to spot crime. Although because I used to I use it all the time in my market, it's the way I look at different places is pretty consistent. But I have noticed it's not great when I go to some other markets. And so if anybody has a suggestion for that, definitely let me know. Okay, so decent crime. Not very happy about, at least in the last couple of days. I get concerned whenever I say something positive about a property, right? Like if I tell you, oh, look at that, and like, what if that's an anomaly, right? So that's why you always want to look, and don't just take my word for this stuff, right? You want to dig deeper, figure out, look at everything that you can, and like I said, like I always just say, do your own due diligence, right? Like I'm doing these videos after a couple hours of research, often. Sometimes not even that much. And so it's important that, if you're going to put some significant capital in here, that you're looking it up as well. All right. So talking about doing our own research, let me just close some tabs here. One of the things, I find, one of the things they mentioned, and I find them to be pretty good with this is, their year one underwriting for revenue, is, they're projecting below, the trailing 12 months. And so I feel like they're always really conservative on their income projections. And we've seen that. We've had some properties that have outperformed quite a bit. Now, last month we did have some dips, right? And so we'll have to see, are we really going to, have these serious outperformers, or are they is what I look at them being, conservative, actually just being realistic because of shifts in the market. Only time is going to tell with that. But where many of the, oftentimes I've taken, I've had a little bit of a disagreement with them, and a lot of the properties that I haven't bought comes down to when they're looking at their valuations, right? And for me, yield is temporary, basis is forever. If I have a fantastic yield, it might make me pay up a little bit more, and you've seen that. I've been comfortable with some properties that I think are on the cusp of us paying too much because they have fantastic yields, but I don't want to overpay, right? And so I'm a little concerned with these comps. This is not, we've had some that were much further off than this. This is not that far off, but I want to share a couple things. So first of all, you know, obviously I always like to use Zillow and all the different estimates. We've got 248. Well, I didn't even mention this. This is the purchase price is 360. So 248 is considerably off. So I'm like, okay, well, let's take a look at another one. What is this now? Realtor says 261. Okay, still 100,000 low. And then Redfin, all three of them think, wow, we're way off, right? Now, one thing to keep in mind, we do always get a appraisal contingency, and let's look and make sure that we see that on here. I don't know why I don't have this open still. Let's see if we've got our... Okay, that's the H... Oh, so it is in an HOA too. Addendum for property subject to mandatory membership in a homeowners association. So this is something that worries me for a Padsplit, right? I don't want to be in an HOA when I'm doing anything other than a long-term rental. I actually missed this earlier. Usually I notice it when I'm looking at the Zillow data, but I guess did I just miss it altogether? And it's, yeah, they have a HOA, $33 monthly. So it's a very low payment HOA, which often indicates that they're not exerting a whole lot of control or they're not doing much. But it's still, again, I mean, it's an additional risk. Even if there's not currently a problem with the HOA, it doesn't mean that there won't be in the future. So that is problematic. Let's see, we've got our financing addendum, but addendum regarding residential leases. Oh my goodness, where are we? Non-realty items addendum. Do we not have the appraisal addendum in here? Let me look again at their third-party financing, solid disclosure on lead-based paint, non-realty items addendum. Okay, so that's interesting. So this is actually really common for the TREC forms. In our third-party financing addendum, we have this property approval section that basically says if the lender doesn't approve of the property, that's a reason that you can get out. And this is, the third day before closing. So a lot of agents look to this as being our appraisal contingency. There is a separate appraisal contingency we can use in Texas with the TREC forms. One of the reasons that you see that you would do that is, so we've got, this doesn't say what the LTV is, right? It only tells us what the loan amount is. And so if the lender can approve us for $288,000, even though the appraisal comes in low, but they're doing it because what they're doing is increasing the LTV, you can have a situation where we do have a low appraisal, but this protection isn't triggered. Now, that is, for me, it's something that my team always does, but I think it's a little bit of a theoretical risk, right? Because you can normally your lender, if it does appraise low, they're going to give you a letter that says we can't approve your financing if you ask them to do so, right? And so having this, this second, so a lot of agents are just relying on this property approval section in their financing addendum as their appraisal contingency. I don't like to do it, but it is pretty common practice, and I guess that's what they're just relying on here. So that's interesting, because I know they mentioned they always use an appraisal contingency. That strictly speaking, that is not one. So it's I don't know. That's kind of interesting to see. I'm trying to think about the other ones that I've looked at from them, if that's the way they've done it as well. I'm really used to seeing it like when agents that are not on my team that I run into out in the wild are submitting offers. I hardly ever see people use the actual appraisal addendum unless they're trying to waive a portion of the contingency, right? Unless they're saying we're still going to close even if it comes up short and we have to bring in some extra cash. So I don't know. I mean, I think, like I said, a lot of agents look to that financing contingency and point specifically to that lender approval of property to be a proxy for an appraisal contingency. Anyway, so we have that, right, and so the risk of overpaying significantly is somewhat low as long as the appraiser comes in at that number. But I often, appraisers are just really good at coming up with a number that matches your contract price, right? Like it is uncanny how often that's the case. Now, I have had low appraisals, and I also have had properties where I bought and the appraisal came in way above where we bought it, and it made sense because I thought we were getting a great deal. The comps on here look like they do a great job of, square footage and prices. But one of the things that I noticed is these are not the actual sale prices. These were the last list price for these properties. But like this one sold for $317,000, not $355,000. This one sold for $340,000, not $345,000. It doesn't change the math that much, right? This one was $379,999 or something, so it was basically $380,000. So it would change your math a little bit, but not too terribly much. So this is one, but this is the one that sold for the $379,999. It was a full renovation, nice flip. Does it look like our property? Not really, right? So is it, is that a good comp for us? Well, if I were going to list this home for somebody, this is not a comp I would use, when I'm coming up with a price. Like this is, but it's always tough with the pad splits, right? Because you're not going to find exact pad splits, and this property isn't going to generate the same kind of money that a pad split will. So, that being said, if why I care about the appraisal and the valuation is, if we have to sell all this property because the pad split business model isn't working, how are we going to do, right? So I don't think this 380 is a very good comp, just because of how much this is just a brand new renovation and the way it looks and compared to our property. Let's see, is this the second one on the list, or do I have them out of order? No, okay, it is. This one, I think we're getting a little bit more like ours, although again, nicer kitchen. I mean, a little bit higher end, but not not a brand new renovation, but it is, looks like nicer finishes. I mean, we just have more pictures of it, so it's tough to know for sure. And then this is the one that the sale is actually $317,000. So maybe that's closer to a real price for us. What was the size? This is a little bit smaller than ours, so there's that. And then this is the one I think went for $340,000. I think it was $340,500. Yeah, and this is the one I think is okay. This comp is, it's very similar to ours, right? It's not. This is not a recent renovation. It's not. This, I don't know. It's a little bit dated, right? Where I feel like ours kind of is, or just not. So, this kitchen just doesn't. It's not as wow as some of those other kitchens. So again, maybe this one makes a little bit more sense as a comp. This one is almost 300 square feet bigger, or is it more than 300 square feet bigger? Let's look again. Right around 300 square feet bigger. A little bit more actually. And, sold for $340,500. So, makes me feel a little bit like we're overpaying for this one, based on a pure sales comps. And then the other thing too is we had to go outside of our subdivision to find these comps, right? And I think that's usually if I'm doing sales comps, to the extent possible, I'm only going to look inside the subdivision. My guess is that's where these prices, that's where these, that's the comps that are being used on Zillow. They did pull one over here too, but you'll see, it's really a best practice if they exist in the subdivision. Now, the thing that'll happen is some of these sites will take properties that are older sales, in order to stay geographically, tight, which I don't know if that's what they're doing here or not. I think it's possible. So I don't know, with their comps, I think they're reasonably close price wise, but again, I don't think this is a great comp. This one actually sold for significantly less than what they think. And so I'm wondering how come they have this bad data, right? I mean, I know they have an agent. It's a Houston agent. They should be able to see the same comps I can when I look them up. Maybe they got them, and then when they put them in here, they just didn't put the right thing in. I'm not sure where that disconnect is. This has happened a couple other times, or at least one other time, where I could see, I could look up the comps that they had, and the numbers that they had as the sale price was not the actual sale price for the property. I don't know if that's a instance of their agent, not doing the best job, or whatever it is, or it's just not getting passed along right. I mean, or where maybe this data is getting pulled from somewhere else. So anyway, it seems to me maybe we're paying a little bit of a premium here. Again, if I liked everything else about the property, a few of these I have bought where I think we're paying a little bit of a premium. But, okay, let's. Oh, and one more thing before we wrap it up. Let me see. Yeah, I didn't even show you. So this is also just like very squarely in a subdivision. I know it is operating as a pad split, right? But it's, and there's a long driveway and parking in the rear, but it's really hard to see how, how many cars you're actually going to put in here. Like, because, even though there's a long driveway, you're not going to do tandem parking in this driveway. And so maybe you do like 1, 2, 3, 4 that can all pull in this way. And then you have a couple of street parking. So I think that you're probably okay. But again, where you have, that only gets you to 6 though, if there's 4 going this way. I'm not sure, so I don't love the parking situation on it, especially because we're in an HOA, right? Like there's an enforcement mechanism in place if people want to complain about this, them and what they're doing. It's certainly possible. So even if there's not a problem right now, I think, parking's not great. I did like the neighborhood itself though, right? Like when we actually just, do the little walking around guy on the Google Street View, like it looks like a perfectly nice neighborhood. I didn't see any like graffiti. I didn't see, just there's not a ton of cars parked in the street. There's not, broken down cars and driveways that you can tell. Overall, that's something I did like about it. But, yeah, I think the parking, it does seem a little bit questionable, even though there is it is a great driveway. Like if you were just using it as a long-term rental and it was a rather large family, I think you'd have no problems. But when you have, the pad split model where, you're not going to have, you're just not going to have tandem parking, right? Because you're not going to count on, I'm trying to move this map here. I'm just pulling that over. You're not going to count on the other members there to move their vehicle for you. It is not too terribly far from a bus stop, but it's also not the closest one that we've seen. So, you could tell there's a lot of things. There's a lot of like reasons that I don't like this one, right? Starting off, I'm going to just wrap it up. The numbers, right, on average, just not great compared to the deals that they've been putting together. I did also want to mention, it's an 8-bedroom, 2-bath. This is one of the worst bedroom to bathroom ratios that we've seen. The private bathroom rooms tend to rent better. So we don't, I would assume we don't have any of those here. Because then if you had one, then you'd have 7 sharing the other. So I'm guessing it's, 8 rooms that are all sharing 2 bathrooms. That is allowed with pad split. They will do 4-to-1. But I really like to see ones that are, a little bit better than that, and we have seen them from them, right? We've seen the 6-bedroom, 10-bathroom or 6-bedroom, or, not the opposite of that, right? Like where you have quite a few bathrooms, where there's a lot of private baths and then the remaining ones are sharing like 2-to-1 or 3-to-1. Yeah. So I think I don't like that. their average numbers, their numbers are below their average. Oh, and that's the only other thing we didn't do. They are using a refinance to make this better, just like they always do, right? But when you get rid of it, how much does it change it here? 12.0. Oh, and then we're getting down even worse, right? 12.2. Let's turn that back on. 13.1, 12.7. So I mean, it's doing a little bit of work here, a little bit more than normal because maybe just in my mind, right? Because it pulls you both into the 12s. This is a situation where, because Mogul has been putting out what I think are fantastic deals, this doesn't look like a great deal, right? I think if you went out shopping in your market and tried to put a Padsplit deal together, you'd realize it's still difficult to find a deal this good, right? But for me, unless it starts to be like, okay, these are the only deals we see from them, this is going to be a pass for me. Between between the lower numbers, I really don't like the 4-to-1 ratio. I don't like that it's in a HOA. I don't love that it's in the shaded X zone for the flood map. The valuation, it seems like we're paying up a little bit. We are getting it fully furnished, right? And that's one of the things to keep in mind. Like, all the units are furnished. It's not like we're getting tons of money worth of furniture, because it's pretty sparse. It's not like when you're getting a short-term rental and things are like, sort of opulent furnishing and whatnot. And there's not a whole lot of common area furnishing involved. Do we have better pictures in here, I wonder? Let's see. Yeah, nothing spectacular. But it is, it's what I expect for a Padsplit, but so I just don't want to oversell the fact that, hey, we're also getting some furniture in that valuation, right? Obviously the fact that you are getting an operating property versus like having to go through that ramp up stage, it's still, there's a benefit there. But overall, I think that if I wasn't used to their average deal, I wouldn't hate this deal. Like, if I compare this to the average Lofty deal, I'd still probably pick this over the vast majority of the properties that have been listed on Lofty. Their day one $50 per token. I think we've got better value here than a lot of those, right? So it's not as if I think, I don't think this is like I don't think they've absolutely lost their mind on it, but I think when you compare it to what we're used to seeing from them, this seems like somewhat of a misstep. Part of me thinks that it's because, okay, they sold out those Houston Padsplits so quick. There's demand for Houston Padsplits. They're just thinking, hey, let's meet that demand with whatever supply we can find. It's not necessarily an attitude I love to see. Like, I don't want, hopefully their standards don't decrease too much, right? Like, because this just has a lot of little things, and then on top of it, the numbers aren't great, right? And so, I don't know. I'm curious, are any of you, my cat just jumped on me. Are any of you guys planning on investing in this one, or ladies? I did notice that there's at least a couple ladies that watch this now too, which is good. Most of you are quiet in the Discord, which I don't know if I mentioned. Please join the Discord. Share your thoughts on this property and any other investments that you're doing, fractional real estate investing. I think it's probably because, it's not the, I think we have a pretty friendly group, but, the internet in general is just not super friendly, right? I think that's why it's guy dominated. Anyway, weird aside. If you are planning on buying into this, let me know. Do you not really care about the HOA? Does that not bother you? Does any thoughts on the shaded X flood zone? I know we've talked about that a few different times. And then just their numbers, right? Like, is it like how much? So one of the things is, I talk about this a lot, is I don't really, is it 8%, 9%, 10%? What's that initial yield? Is not what's going to make a big difference in our portfolio at the end of the day, right? Obviously, higher numbers are better, but real estate returns across your portfolio are, the negatives have a much larger impact than the positives, right? Like, yes, I'd rather have more double-digit returns than not, but more than anything, I'm trying to avoid risk in the portfolio because we're never going to have these crazy outsized returns on to the upside, but we can have big losses to the downside, and so I'm always much more concerned with just, okay, let's kick out anything that has greater than average risk, as long as the return is reasonably okay. This is one, I think, because it's bringing down the average return on my portfolio on Mogul, and there's several of these risks identified. It's hard for me to understand how this one came up compared to the rest of the stuff that they've given us. I'm curious if I'm missing something, right? Like, is there some appeal here? It is a part of Houston. It's a different part of Houston. They did mention that Padsplit has real strong occupancy in that part of Houston, like 93%. I'm not super familiar with it. Like 20 years ago, I lived over here for, I don't know, 6 or 7, maybe just a summer actually. But I spent a lot of time there the year before that as well. But then more recently, I lived down over here. But this was still talking 12 or 13 years ago. So I haven't spent a whole bunch of time in that part of Houston. I don't know if there's some other strategic reason we might want to be there and be willing to pay more for it. But I didn't see it, right? For me, this deal is just, it's kind of a ho-hum. Again, like, I think it's probably better than most deals you're going to find if you just went and hired a random agent and said, hey, I want to go buy a pad split in my market. I think you'd have to work real hard to find something even like this, which is just, it's just really shows like how well their other deals are. But for me, I'm going to pass on this one. And that's the thing, right? We don't have to buy everything that they put up. I think my purchase rate has gone down by, I used to say, 1 out of 3. I think I'm probably closer to 50%, buying ones. I did buy a piece of the Swift this week, finally, after, waffling on that a little bit. They were getting close to selling out, and I looked at it again, and I looked at my original video on it, and I liked it a lot. I thought there was a lot of reasons to. But again, do your own due diligence on it. Don't just buy it because I said that. Yeah, I think that's everything. Until next time, I'm just going to keep making mistakes so that you don't have to.